Hi guys, and welcome to one of these videos that I always keep on posting. Unfortunately, I've been very busy since the past couple of weeks, so I was not able to actually create some research. And I thought, why not go into a very different direction now and talk about some controversial, models which we usually use. Most likely we use it in we've all learned through an MBA syllabus, CFA syllabus. Most of the syllabus will have the capital asset pricing model. And I came across a very interesting article which was written by Saurabh Mukherjee, who's actually the CEO of Marsilius, and he was the ex-CIO for Ambit Capital. And always had questions related to this. And somehow I did know the fact that the risk and return calculation that we usually do is not as straightforward as we think, right? And from there, the article I read, and I thought that why not just test it and show it to you that why the capital asset pricing model is actually a very blind calculation to calculate the expected return from a investment or a stock. Okay, so just for some thoughts to get registered probably in your mind, what I've done is I've created some initial slides, and then I'll take you to the template where I'll show you how the testing proves the same concept that I've just read. Okay, so what's the basis of this? So risk and reward is something that's always discussed, right? It's a general theory. When we even talk to our friends, we talk to people, and we say that what, we have to take higher risk for a higher return, right? And that's the basis of probably all the calculations that we've done, right? And how does that get justified? So I mean, the CAPM formula is nothing but RF, right? Which is the risk-free rate, which is your 10. If you were talking about India, so that's your 10-year government bond yield, right? So you're saying that the 10-year government bond yield is already risk free. So that if let's say it's about 6.9%, so then you say the 6.9% is already free, right? So if I am expecting anything from investing other than the government bond yield, then I would be expecting more than the risk free, right? That was the premise of CAPM calculation in the first place, right? So that's where we start, right? But then there is something called as the beta, right? And this is basically for a specific investment, right? So if you're talking about a stock, then you would want to find the stock of that company, right? The beta of that company, and compare it to the risk premium, right? So this is nothing but risk premium. So what is RM? RM is your benchmark return. So it depends upon which benchmark you're using. So if it's a large cap stock, then your benchmark would be Nifty 50, right? Now there are a lot of debates there also, but generally speaking, Nifty 50 is a dummy for RM, right? So if 15% is what the market gives me, right? So if this is RM, if RM is 15% and the risk-free rate is, let's say, about 6%, right? Then the risk premium that you're getting by just investing in the normal market, not a stock, normal market, is about 9%, right? So the premium that you get is about 9%. Now you multiply that with something called as the beta, which is supposed to tell us the riskiness of a particular investment. Now that's the debate, that's where the controversy starts, right? Now if you talk about beta, how is beta calculated? So if you look at those formulas which are given, the standard formula, it's basically you're trying to find the sensitivity, okay, of a stock. So if I'm talking about Infosys, then I'm trying to find the sensitivity with Nifty 50, okay? And basis this, I calculate something called as beta using a formula which is nothing but covariance divided by, so covariance of Infosys and Nifty, and I divide that by the variance of the market, right? So standard deviation of the market square is nothing but variance. So this gives me some number like 0.71 or 1, right? And Nifty 50 has a neutral, right? And the benchmark will obviously have a beta of 1. So if you have a lower beta, then you are saying that the stock is lesser risky compared to Nifty 50. And if you have a higher beta, if let's say the beta comes out to be 1.21, then you're saying it's more risky than Nifty 50. Now that's where the debate starts from. Okay, now that's where we will try to use data. And what you see out here, the chart you see out here is the risk and reward trade-off that we are talking about, the conventional conventional risk reward trade-off. So if you see out here, we've got and I've just taken it from this the Saurav Mukherjee's blog out here, where it's a nice fantastic chart which is made. So if you see here, these are your CAGR returns on your x-axis, and on your y-axis you've got different kinds of investments, right? So if you see bonds obviously fall under the lower return section, right? And also their risk is lower, right? But as you keep on going, okay, above, so if you see Sensex long term, then this is where it is, right? So I mean, your risk is increasing, but so is your returns, right? So your returns are also increasing out here. And if you talk about Sensex short term, then yes, your returns are increasing, but then so is your risk, right, on the y-axis. If you talk about quality small caps, then your risk is increasing definitely, but so is your return, right? Now this is where the concept is that, is this really true, right? Does this really work like that? Or it's the opposite side, wherein we are saying that higher risk does not mean higher return in India. So lower risk means higher return in India. That is what we wanted to test it out, right? So I understand that this is a little intriguing, it's a little confusing. It might not be very intuitive, but when you look at the data, that's where you will get convinced on this concept. Okay, so the basis that we are trying to understand is, are returns and risks, is it actually negatively correlated? Because if we are saying higher risk does not mean higher return, that means they are not correlated, and probably there's a reverse correlation or a negative correlation, right? Now the testing method which I've used is, first of all, I've taken data from different indexes. So we don't want to really go stock specific, because stock specific it will become very difficult. We will have to generate too much data. So I've taken Nifty 50 as one of the indexes. Then I've taken Nifty 100 just to be sure. Nifty 100 is just nothing but the extension of Nifty 50. Then I've taken the mid cap 100, okay, the popular NSE index for mid cap stocks. And then I've finally taken small cap 100, which shows us the highest risk. So this is supposed to be highest risk, so it is supposed to give higher return, right? And if return, I'll just write that. And Nifty 50 on the other hand is supposed to be lower risk compared to small cap, so lower risk, so it should give you lower return, right? And that's the order that should be followed from here to here, right? If I were to believe in the CAPM model, right? But it does not matter what we believe, what we believe or what the theory says doesn't matter. The data should show that. Then what I've done is, I will also show you this. So we've also calculated Sharpe for various indexes. We've also calculated MAR, Managed Account Report Ratio, which actually takes into consideration drawdown. I've also compared risk, standard deviation and drawdown, and I've also changed years just to remove any bias and see whether does it really hold true that higher risk is higher return. Okay, so let's switch to the template. All right, so welcome to the lab. This is where things get calculated. So I've taken Nifty 100 as an extension of Nifty 50. So what I'll do is I'll try to keep Nifty 50 closer to Nifty 100 so that they are somewhat related, right? Then you've got your mid cap, which is supposed to be better than small cap in terms of risk, right? And small cap is the highest risk and should give us higher returns, but does it, right? So Nifty 50, we have data since 1997, so not a problem. But we can't really compare from 1997 because Nifty 100, Nifty mid cap, Nifty small cap have not started from 1997, right? So we took the common years as 2016. So from 2016 onwards, we started analyzing both of them. Now, what I've done is I'm not going to calculate because it's going to take too long. It's going to be very difficult to follow. But what I've done is I've calculated 2016, 17, and 18. So what we're assuming is that what if we start investing in Nifty 100 from 2016? Okay, what if we start investing 1000 rupees in 2017? And what if we invest in Nifty 100 from 2018? Just to remove the bias and see whether the performance or the theory still holds true, which is higher risk is higher return. And I've done the same for Nifty 50, mid cap, small cap, and done a comparison out here. Okay. Also, along the way, I have also calculated something called as the drawdown. Drawdown is nothing but the retracement of the value of your portfolio from the highest point. Okay. And the same thing again, I've done it for 2016, 17, and 18, right? So let's see what the results were. Okay. We'll spend more time interpreting the results because the calculation you can always do anytime. Okay. So you first of all, let me just show you the final chart that I got if I considered that the investment happened through 2016 in all of these indexes. Okay. So let me just take the portfolio value. So this is where my portfolio value is calculated out here. Okay. So you can see that I've started investing in all of these indexes from 2016. I've taken Nifty 50, Nifty 100 and mid cap. Okay. Just to show you whether it has any significant differences. Okay. So let's take and create a chart, and I'm just going to change this series chart type to line. Okay. And there you go. So Nifty 50, if you see, is at the top. Okay. The blue line that you see, it's even beating mid cap. Okay. If you see, the lowest one is the small cap. Okay. And you can see the dip in performance of the small cap. If you see mid cap, it's out somewhere out here. Okay. So basically, it is the larger companies, Nifty 50 and Nifty 100, the 100 biggest companies are actually giving you more value than probably the higher risk companies, right? So smaller cap was supposed to give you more returns, right? Unfortunately, they're not, right? At least this chart is telling us that. Okay. So that is one insight. Let's go to some other deeper insight. Okay. So I've created some more advanced calculations out here. So if we start looking at standard deviation, okay, as one of the popular measures which are calculated in India specifically for stocks, right? Stocks, mutual funds, whatever, right? If I look at Nifty 50, then if I measure from April 16 onwards, my standard deviation 17.6 annualized. Nifty 100 is 17.3 expected, right? Nifty small is supposed to be higher, and Nifty mid cap is about 19.2. And if you see in all of these 3 years sampling that I've done, in all of the cases, mostly your standard deviation is obviously lower with Nifty 50, which means low risk, right? I've taken the respective RF, which is the risk-free rate, okay, basis year. So April 16, as per the data I got, the RF was about 7.4. April 17 onwards, it was 6.9, and 18 onwards, the 7, it was supposed somewhere around 7.7. Now, if I look at the returns now, okay, from 16 onwards, if I see, okay, mid cap generates the highest returns, okay. Nifty 50 generates 14.7. Nifty 100 also generates 14.7, but small cap in turn generates the lowest returns. Okay, so that means probably there's a mismatch on higher risk is higher return, right? April 17 also, just so that probably there's some data bias. So I start calculating from April 17 onwards till 21. Nifty 50 returns 14.6. Okay. Nifty 100 is 13.3. Small cap is 8%. Okay. And Nifty mid cap is about 11.3. So even then, the largest companies are performing better. You might say that okay, 17 also might be an issue, so I go to 18. Okay, and in 18 also, it's Nifty 50 is still performing well compared to the smaller peers, which is small cap and mid cap. Now let's look at, I mean, these returns are fine, but on a risk adjusted basis, if you just calculate the Sharpe, which is nothing but the return minus the risk free rate divided by the standard deviation, you'll see in all of these 3 years on a risk adjusted basis, if you see out here, okay, you are far better than the small cap. The small cap is, the Sharpe is about 0.29, okay, and the Sharpe in Nifty 50 was about 0.41, okay. So for 1 year, the Nifty 100 and Nifty mid cap probably are performing far better than the small cap stocks, right? April 17 also, the same story repeats. Look at what happens in April 18. So when you shorter the duration even further, the performance of small cap goes for a toss, right? Let's look at drawdowns, okay, from highest point to the lowest point. So even in Sharpe, if you look at the Sharpe, whether you look at drawdown, whether you look at MAR, in all of the cases on the risk adjusted basis, they're actually performing better. And okay, now if you want to see this, if this is too confusing as a table, you can obviously look at the charts. Okay, charts are a easy way of summarizing things. So if you see Sharpe, these color coding mean different indexes, right? So if you compare it from Jan 16 onwards, the Nifty mid cap in terms of Sharpe is better, right? But Nifty 100 and Nifty 50 are not bad either, 0. Very similar, right? But small cap doesn't really perform well, right? If you look at from Jan 17, the small cap is still worse, and in Jan 18 onwards, if you see, it's disappeared. So small cap indexes, which signifies higher risk, is not generating higher risk adjusted returns, right? Look at the drawdowns, okay? So these are returns. Again, different indexes, different periods, okay? So if you see from April 16 onwards, this blue thing means nothing but 16, the orange is 17 and 18, right? So if you see Nifty 50, from 16 onwards, it's about 15, 17 onwards, 15, and 18 onwards, 18, right? Nifty 100, somewhat similar because it's an extension. Mid cap is also not bad. It's very close. But look at the drawdown. 20%. The right scale that you see is basically drawdown. So if you see out here for Nifty 50, the drawdown must be somewhere around 40%, right? Nifty 100 is also 40%, but small cap is going around 65%. Okay, and mid cap is understandable that it's higher than 40%, but it's not as great as 60%. But they're generating more returns for that, right? Look at the MAR. Okay, again the same depiction of managed account report. If you see Nifty 50 is somewhat stable across years, right? The risk versus return. Nifty 100 is also pretty similar. But look at what happens to small cap and mid cap. So that's the summarization, guys, that probably what the blog said on the fact that probably the CAPM is not true is because, probably in another video I'll cover that, is the fact that beta is actually not correlated with returns. So your sensitivity that you're trying to calculate for your stock is itself probably invalid. And that's the reason why your calculation for CAPM is going wrong. And probably because of that, you're losing a lot of money in the longer run. Okay, so this is just a small research insight I thought probably might be insightful for you. Do let me know if you actually found it interesting, and if you want to have this file which I just calculated. With a lot of effort I've calculated this. If you want this file, please do let me know. I will share it if you comment on the video that is posted out here. Okay, so best of luck. I'll see you with some better insights in the next video.